G'day there. Welcome to the closing bell on the 25th of March. Recording this on the Friday afternoon, and boy, it's been a lot going on, hasn't there? We have a lot to figure out. Interest rates going up in the US, markets sitting on the edge of those very important support levels. But, have the central banks saved the world with all of the interventions after we had Credit Suisse go under? SVB, a few banks collapsing, deposit runs. Boy, it's not all the time that I'm talking about such things. And it's important to figure out, is there more to come? Are we still going to get worse news down the track? Could this banking crisis morph into something a bit bigger? Or is it now contained? So I just thought I'd show you a few different charts to kick things off, give you a sense of why I think there could be more problems afoot than people would like to really mention at the moment. So I just wanted to take you through some commercial real estate companies in the US that I've just had a look at, and boy, they don't look too hot. So it sort of makes sense to me why this S&P bank ETF is still on its lows after selling off in a straight line for a month, as you can see there. And that chart to me doesn't look like it's reached a low point yet. So even though markets have been trying to bounce, and look, perhaps they will in the future, and I'll show you those charts in a minute. But, there could be more troubles afoot in this sort of commercial real estate area, which you should know. Those regional banks very exposed to that area, quite a few of them. So, there could be some problems to come out of the woodwork there. So I'm just going to quickly flick through these charts of a few commercial real estate exposed companies in the US so you can get a sense of what is going on at the moment over there. This is Hudson Pacific Properties, New York Stock Exchange listed. And wow, look at that. Breaking down below the major lows from 2011, sold off from $28 to $5 in the last few months, and is on its lows at the moment. Where is that one heading? Is it going to be in business? Who's been lending the money? These are the sort of charts that I'm looking at where I'm wondering if there's some bigger problems afoot than just a liquidity run on these regional banks in the US. So the next one to have a look at is SL Green Realty Group. You can see back in 2008, they went from $170 down to a low of, about $20. Then up into 2016, they rallied back to 140 and have been selling off ever since. And from 2022 onwards, they've fallen from $80 to their current level below 20. And they are really accelerating to the downside at the moment. That is not a pretty looking chart. This is Piedmont Office Realty Trust. Again, a really strong nosedive occurring at the moment, going from mid-22 to the current time, and really actually accelerating in the near term. It's headed under $10 and falling down to $7 just in the last month or so, falling from a high of $25. From mid-22, you're looking at a fall from about $20 down to $7. So that one looking pretty sick. This is Cousins Properties Incorporated. You can see they really sold off hard back in the crash of 2008. They've been struggling to recover since then, rallying though from $20 to near 40, and from middle of last year going from $40 and now plumbing underneath 20, and they've sold off just in the last month from $25 to $18.50 and selling off pretty hard. And finally, Kilroy Realty Corporation. Again, you can see the big waves that we've seen with the 2008 crash. seeing them fall from around $100 to 20. But we're seeing a similar move, aren't we? They've gone from mid 22, around $80, currently trading 27, and they are falling in a straight line. So there is a bit of distress over there in that commercial property sector, and how that plays out may be the underlying forces that are seeing a lot of this very strong selling pressure in that banking index. And perhaps that is the next shoe to drop, which could get this crisis moving and seeing those index charts I've been chatting with you about really cracking beneath major support zones. So let's have a look and finish up with where the indices are at the moment. Well, I think this S&P 500, the daily chart, really says it all, doesn't it? And nothing much has changed from last week. And I'm really forcing that point home that there are areas above and below the market now after this 18 months to 2 years of selling off that are making it really clear for me where volatility should pick up and, where the bullishness and the bearishness changes. So it's nice to have that. It's nice to have the lines in the sand. I'm just going to keep forcing that point home as we see this market gyrate around. And for people who haven't been watching, in the S&P 500, I'm looking at that 43.50 level, which is the last major high within this long-term downtrend that's taking shape. So above 43.50, I'm sort of changing my tune a bit, thinking that the market can rally. And my odds for me at the moment are that the downtrend will continue, but I think the real selling pressure picks up dramatically below 3,800. And I explained in detail last week why that was. And a simple overview for you is that the downtrend is certainly in place, but we do have this buying pressure that's been going on for the last 6 months, and that uptrend is also intact. So it's a bit difficult to say exactly which way this thing's going to break, because that uptrend could survive, and if it does, if we break out to new highs, that could be the beginning of that leg higher. So the thing that really brings that current uptrend undone is if prices fail below that 3,800 level. And you'll see that just in the last few weeks, we nearly got there. That was when banks were failing and no one knew what was going to happen. And we've had the rescues from the central banks. So the market's sort of been rallying away from that level, rallying back above that 200-day moving average, which is so important. So the question remains, is that buying going to continue and take us higher and away from the 200-day moving average? In which case, the central banks have saved the world. And if people think the rates aren't going to go too much higher, perhaps things settle down. But if we see the selling return and it busts back below that 200-day, as I said last week, and now we've got real dominoes lined up beneath 3,800, below there is where you've got to say, watch out indeed. And we have the low of the whole correction, which I've taken you through many times. Below there is really dangerous. So that's around 3,500. And I'd expect if the market did breach those lows from last year, that you're going to see a big clear out of positions, which is going to lead to some great opportunities down the track. But just as things stand, with the market, getting a little bit bullish on the back of the 25 basis point rise, thinking that it's not going to go much further. The yield curve starting to change, starting to steepen, going from an inverted level now. But we're also heading to a point where growth may start to falter on the back of these sharp interest rate rises. So don't forget that often in the past, the Fed was cutting rates and stocks actually sold off at the same time because growth was faltering, earnings were going down, and the stock market sold off even as the Fed was cutting rates madly. So the fact that they stopped raising rates isn't necessarily saying that stocks are going to take off like a rocket to the upside. So all up, not much has changed over the last week. If you've been watching these videos, and you know that it's been 10 months of a very difficult market, especially in the US, where it's just gone sideways as everyone tries to figure out what's coming next. But, you know, looking at those banks, they're still on their lows and looking weak despite all of the intervention. And when you look at those commercial real estate companies, you do start scratching your head wondering what's coming next and what may be the repercussions if that sector really starts to falter. All right, well, that's enough for this week. I shall come back with more next week. Cheers.